Welcome back to Switzer and Sky News Money. Investors who reject term deposits because they are paying stingy interest rates but wary of stocks sometimes fall into investment products like hybrid securities. So let's road test these with my Switzer Super Report colleague Paul Rickard. Hi Paul.
Hello Peter.
Now hybrid securities, a lot of people like them because the interest rates are much higher than term deposits. How safe are they?
Look, I think they're generally pretty safe. I mean, they're obviously...
You hesitated.
I hesitated there because I wanted to make sure I didn't in any way suggest they're like a term deposit.
Okay.
And for most private investors, term deposits or a deposit in the bank has a government guarantee up to $250,000. So for most of us, you can say term deposits are by and large riskless. Yeah. And certainly a hybrid security is not riskless. I categorise it, Peter, as sort of part of the risky fixed interest part of my portfolio.
Okay, so give people who aren't sure about a hybrid security the definition of what it is.
Yeah, so essentially it's a cross between debt and equity, hence the name of hybrid, a bit like a hybrid car, which drives on multiple things,
That's a Prius, is it?
It's like the Prius. A little different. So it has both debt and equity-like features. The debt features, obviously, is it pays an interest rate, and you get that interest rate every 3 months. For most of the hybrid securities, that interest rate floats, so it floats relative to the benchmark 90-day bank bill rate. So that's sort of the debt-like features. The equity features is that it is still a form of capital. So for the banks who are issuing, by and large, the biggest issuer of hybrid securities, it counts for them as additional Tier 1 capital. So if something goes really wrong with the bank, then this is going to be called upon. And so essentially, your hybrid security then converts back into ordinary shares. And so that's going to happen only in pretty bad circumstances. And so that's the capital nature of it.
So when they do that and you end up with the shares, I guess if you hang on to them and the bank recovers, well then you can benefit. But it could be a long-term repair job.
Yeah, I mean, you don't want... They have what are called these sort of capital triggers. And one, there's 2 triggers. There's the capital trigger if the bank's capital ratio falls below a certain level, or there's the worst sort of trigger called a non-viability trigger, which is basically APRA saying to the bank, you're getting close to being insolvent. And these sort of instruments get called, and you don't have any choice. What you think is a debt instrument suddenly becomes ordinary shares in the bank, and that's going to be in pretty bad circumstances. So, your $100 investment is going to be on paper worth a lot less. That's the risky part. Now, the trade-off to all that, Peter, is the banks are all out there raising more capital because APRA is saying to the banks, we want you to be...
more secure.
Not just well capitalised, to be unquestionably strong, and that's actually a real positive for the hybrid market because it means that there's less likely, if the banks get more capital, there's much less likely the banks are ever going to need this additional capital. So APRA is pretty important to hybrid security investors. Yeah, they can be both a positive and a negative at the moment because they're saying to the banks more capital. It's actually a positive for hybrid securities in the long term.
But also, I guess, Paul, if you're in hybrid securities and this economy starts to improve over the next 2 or 3 years, up goes a 90-day bank bill and you get a better interest rate return.
Yeah, so as you say, they're a floating rate instrument. So they're priced at a margin. They have a fixed margin over the 90-day bank bill rate. 90-day bank bills at the moment about the same as a cash rate, about, say, just over 2%. So with if you have a hybrid security paying a fixed margin of 4%, and we'll talk about the Westpac issue, the new Westpac issue later, you get roughly about 6% for the first quarter. If interest rates go up, as I don't think anyone expects in the short term, but if the economy picks up steam, 18 months down the track, interest rates have now moved up, the bank bill rate is then, say, 3%, you'll get 7%. If the bank bill rate had moved up to 4%, you'll get 8%. So they float over the benchmark rate.
When do you expect to get your money back from a hybrid security?
Well, there are 2 key dates. One is the date when the bank can start to convert, and that's typically 7.5 to 10 years later. And there's another date which is shorter than that, which is about 5 to 6 years when the bank has an option to redeem. Now, you obviously bank on the fact that the date they have to start to convert is a date you should expect it, but in many cases, because they have this one-way option, they're priced on the assumption that the bank will probably pay you out at the first available opportunity.
Okay, now imagine...
But the point you're raising, Peter, is that they'd have no terms. So... the bank is not allowed to convert them unless things are going reasonably well. If the bank's in a crisis, then APRA will say, sorry, you can't convert them.
Okay.
And so you won't get your money back.
Okay. So let's imagine after 7 years, the bank wants to, take these out of the play, and you've put effectively $100,000 into a. So do you effectively get $100,000 worth of, say, Westpac shares if it's a Westpac?
Yeah, you effectively get a little bit more than that because the shares are issued at a 1% discount.
Yeah.
But if you put $100,000 into, say, this new Westpac hybrid, at the end of the expected conversion redemption date, which is in 2023, it's about 7.5 years down the track, you would expect to get $101,000 worth of Westpac ordinary shares.
And the bottom line is this, that if the share price...
Or they might arrange a resale or a transfer and give you the cash back, the $100,000 cash.
And for simplicity, if the share price was $10, you would get 10,000 shares. If the share price was 5, you get 20,000 shares.
Absolutely.
Okay, so that's very...
And in most cases, what's happened with these issues, Peter, is they roll over. So they'll bring out another issue and they'll give you a chance to roll into another issue. So your assumption is you're going to get your money back. It's like any investment. It's always a good one to make.
Yeah.
But that's what the market is working on.
And of course there are a few ifs and buts. That's why the interest rate currently is effectively about 6% compared to term deposits around 2%. So people should got to remember that.
Yeah, so you're getting a 4% premium to take on that risk.
Yeah. If you want to get out early, Paul, is there a secondary market?
Yeah, so we can probably look at one of the examples. And so they're all listed on the ASX, and there's quite an active market on the secondary market. So let's look at one of the issues. We've got a chart here up which will come up for the biggest issue in the market. This is the most recent issue from the Commonwealth Bank.
Yeah.
It's called Pearl 7 and the stock code CBAPD.
Yeah.
And that was issued at a price of $100, and that paid a fixed margin of 2.8% over the 90-day bank bill rate. Now, that's gone to a price as low as about $90. So in the bit of the panic a couple of weeks ago, just over the change of the financial year, we looked pretty bad news about Greece. Bank shares are being sold off. That actually touched about $90 on the low. It's bounced back to a bit over $94, and today with the Westpac issue, it's come off to about $93.50. So if you had invested in those securities when they were issued 12 months ago, on paper, you'd be showing about a 5 or 6% loss situation.
If you tried to get out.
If you tried to get out.
Yeah.
Now, the expectation is that you'll get your $100 back, you hold on to the redemption date, and you'll get repaid the $100.
And the thing is this, Paul, as interest rates go up, the price of these securities will go down, won't they? 'Cause
well, not necessarily, Peter. What will happen is the margin might change. So as interest rates go up, you'll still get, for the people who bought this security, they'll still get their 2.8% plus the 90-day
plus the
bank
bank bill rate. Yeah. But if you try to get out early, the price could be coming down.
Yeah. So what's changed here is effectively the margin, and the market said 2.8% wasn't enough.
Yeah.
And yields on ordinary shares went up. So yields on these had to go up, and effectively that's what happened, and that's why we saw the movement in prices.
Okay, the Westpac one coming out.
Yeah, so Westpac today announced their latest issue. It's called Westpac Capital Notes 3. They're targeting $750 million. It'll probably be a lot more than that. It's being priced at a margin of 4 to 4.2% over the 90-day bank bill rate.
Yep.
That margin will be locked in this week. They'll go through an institutional book build process, probably set at 4%, I guess, which is about where the secondary market is trading. That'll trade under stock code WBCPF. So investors can either go to their broker. If you're a Westpac shareholder or security holder, you can apply online with Westpac, and you fork out the money towards the end of August, and this thing will list in the middle of September.
Okay, so when you look at a hybrid security, do you think of them as being debt or equity?
I think of it as being debt, and I'm encouraged by the fact the banks are adding more capital. Now, there are other people, ASIC, don't quite see them that way, but that's my view, so I treat them as part of my risky fixed interest portfolio.
Yeah.
That means it's got some risk. It's not government guaranteed, and I obviously will look for diversification across different banks to get some of the issue or risk out of it. But I think a 4% premium is not a bad premium to take on that sort of risk. And I think the market, where this hybrid market has traded over the last 3 to 5 years, 4% is about the upper end of the market.
Yeah. Okay.
We saw when it got to 2.8 was too low.
Yeah, good stuff. So that's Paul Rickard for the Switzer Super Report. And if you want to know more about the sort of stuff inside Paul's head, go to the switzersuperreport.com.au website, where he explains a lot of this stuff to anyone who's really interested. So Paul, thanks for joining us.
Thanks, Peter.
Okay, so coming up after the break, we'll look at a business that was designed on a superberry.